when do the retailers or the stackers come in again? I think when the next printing round starts, right after, this is going to be after the next repo crisis, and the Fed's going to have to say, look, we're going to have to cut back down to zero, or we're going to have to cut 100 basis points overnight, something like that. I think then the premiums are going to start to rise again, and people are going to start really getting nervous about the dollar, and who knows where we're going to be with the elections, or if there's going to be court cases and riots in the streets.
In today's news recap, here's why silver's bull run hasn't even started. Silver has been on a historic bull run for the last 2 years. At press time, the precious metal is trading in close proximity to a 12-year high. The gray metal has notably outperformed gold in that time frame, buoyed by both high demand and its increasing popularity as a store of value. Gold is actually outperforming silver relative to recent highs. While gold is currently trading at roughly 44% above its 2011 peak, silver is actually priced approximately 29% below its very own 2011 peak price, as noted by Ottavio Costa, a Criscat Capital strategist, in an X post on October 21st. The surge in prices that the yellow-hued metal has seen can be explained primarily by two factors. One, its role as a hedge against inflation and a store of wealth, and two, renewed investor interest on account of the outsized returns that it has provided in the last 2 years. Costa opined that gold's recent move to the upside is caused by the fact that the markets are already pricing in further interest rate cuts from the Federal Reserve, signaling the potential for another significant wave of inflation. Silver, however, hasn't seen a corresponding rise yet, and although Costa believes it is due in short order. Metals and commodities set to mirror gold's performance. If this line of reasoning pans out, silver is set to see a renewed surge. To mirror gold's performance relative to 2011 highs, the gray metal would have to reach prices some 44% above the $46.47 per ounce seen in 2011. In other words, roughly $66.91 per ounce. Compared to prices at press time, which are $33.42 per ounce, this would represent a 100.2% upside. If its current pace were to be sustained, silver could reach that mark in mid-2025, potentially even earlier, depending on macro developments. The Criscat Capital analyst also urged investors to keep a close eye on other metals as well as commodities. Notably, major banks are bullish on copper and nickel, while palladium is set to reach the highest close of 2024. Now we'll show you more clips of the latest interview, but first, smash the subscribe button and turn on notifications so you do not miss out our daily recaps. Enjoy the episode.
Oh, it's been months. And on the one hand, like, I'm emotionally ready for a correction. Like, if gold were to go down 50, 60, 70, even $100 in some kind of like little crunch, it wouldn't surprise me, but it's not happening. And I looked at the commitment of traders in gold. Right. And the worrying thing is that the bullion bank short positions are very near a record high on gold. But what I also noticed is that you go back all the way to 2008, 2009 to 2011, the strongest portion of the gold bull market of that era was after the 2008 crash, right? And then gold goes something from like 642 to 1923. What was it, from October 2008 to September 2000? So about 3 years. It goes from more than triples, about triples. And in those 3 years, the COTs, the commitment of traders, whose position what in the futures market, if you trust those numbers, I don't completely trust them, but I think they're basically accurate. Maybe they look very similar to now. And for most of those 3 years, the bullion bank shorts were at or near records for 3 years. So I'm saying, like, yeah, we're in a dangerous position where you could get people knocked out especially if they're in leverage or doing some kind of crazy trading strategy with options, which I never ever recommend. But those people could get kicked out if they're just trend followers or if they're hedge funds or something. But then again, we had 3 years of this from 2008 to 2011, so we could have that again, and we could just keep going higher from here, just like we did in those years. I don't really know. I'm not gonna try to play it. With silver, silver didn't really make a move until 2010, 2011. So 2008, 2009 didn't do that much. Same thing in the 1970s, like from 1975 to 1979, silver did basically nothing. And then all of a sudden, 1970 to 1980, the last half of 1979 into the first 3 weeks of 1980, silver just goes crazy. That's a signal of the public finally waking up, right? The banks wake up, the financial players who see a little bit deeper what's going on in the derivative system, they make their moves in gold before the public finally wakes up. What makes the public wake up? Well, not the derivative markets, the supermarkets. That's what makes them wake up. Then they go for silver. So we're going to see that at the very, very end. Where silver is going to go in the very, very end, of that cycle, in the hundreds, maybe even the thousands. I don't know. It depends. These numbers don't really mean anything when the dollar doesn't buy anything. So it's anyone's guess, but I do think that the ratio, at least briefly, will fall to 15-1, which is what I'm waiting for. And when that happens, I'm just going to buy a bunch of stuff with silver, and whatever I can't buy, I'll just convert back into gold.
In today's news recap, Russia in talks with BRICS over precious metals exchange. Russia is in talks with other BRICS members about creating an international precious metals exchange to ensure fair pricing and trade growth. The country's finance minister, Anton Siluanov, said in a statement on Thursday. Leaders of BRICS countries, which account for 37% of the global economy, gathered in the Russian city of Kazan this week to discuss initiatives aimed at creating alternatives to the Western-dominated financial and trade infrastructure. The mechanism will include the creation of price indicators for metals, standards for the production and trade of bullion, and instruments for accrediting market participants, clearing, and auditing within BRICS. Siluanov said. The BRICS Precious Metals Exchange would rival Western trading platforms such as the London Metal Exchange and would protect trade from sanctions imposed by the West on BRICS members Russia and Iran. Earlier, BRICS leaders expressed support for efforts to increase trade in precious metals among the group's countries in a joint communique issued on October 23. Russia is the second largest global gold producer, and one of its biggest companies, Nornickel, is the world's largest supplier of palladium with a 40% share of global output. All major Russian gold producers are under Western sanctions, which have also hampered Nornickel's operations and its palladium exports, although the company itself is not under direct sanctions. Nornickel and the country's largest gold producer, Polyus, declined to comment on the initiative. Now we'll show you the best clips of the latest interview, but first, smash the subscribe button and turn on notifications so you do not miss out our daily recaps. Enjoy the episode.
Look, it's a double-edged sword when you talk about premiums. Because on the one hand, you could say premiums are very low, and therefore we're not in a bubble because we still have the retail the retail buyer to come in, and they haven't come in yet, so there's more fuel. On the other hand, if you look at the premiums in 2010, 2011 for silver, junk silver, like the quarters, dimes, half dollars, those kind of 1964 and earlier, they were actually below zero, right? It means it was cheaper to buy physical silver from, I don't know specifically Miles Franklin, but a retailer in a coin shop than it was to buy SLV, right? Briefly in 2011, like let's say when silver was like going from 40 to 50. So for like a few months in that time span, it was cheaper to buy physical coins. That's a sign that silver was in at least a derivative based bubble, right? It was the hedge funds and whoever buys ETFs and futures. They were chasing the silver price higher, or they were caught in some kind of spiral, and it wasn't being reflected in the physical markets. Now, premiums are low, but they're still positive. It's still, it still costs a premium. I think it's like 6-7% for junk silver, which means that there's still some demand in physical markets. So it's not like buyers have totally given up and they don't even want it, right? Which was the case in 2011 briefly. So look, when do the retailers or the stackers come in again? Um, I think when the next printing round starts, right after this is going to be after the next repo crisis, and the Fed's going to have to say, look, we're going to have to cut back down to zero, or we're going to have to cut 100 basis points overnight, something like that. I think then the premiums are going to start to rise again, and people are going to start really getting nervous about the dollar, and who knows where we're going to be with the elections, or if there's going to be court cases and riots in the streets, and where the Middle East wars are going to be. I don't know. We've had like 4 bombs today that shook my house again. I mean, this is not stopping. So it's got to come to a head, and silver is going to be a big part of that coming to it. I guess the decent parts of the financial mainstream media, like the upper class of it, like FT, and they get more academic and more deep into it. They have some good writers there. When they were talking about the basis trade that's being funded by repo, and they started like getting nervous about it, they were talking about 2019 and the apocalypse, and they were looking at the volumes in the 2-year treasury. For some reason, the 2-year treasury has the highest liquidity. So most hedge funds, when they want a basis trade and to snip that little penny off of the difference between the futures and the spot, most of them pick, or a big proportion or a plurality of them pick the 2-year. Right. So when FT was reporting on this, the amount of shorts in the 2-year treasury note were at records at the time. And then they said, oh, don't worry about it. It's going to go down now. The basis trade is out of style and everything will be fine. It's worse than 2019 now, but it's going to go down now. That's what they were saying in their tone. I don't know how they proved it, but they were wrong. Because now it's at even bigger positions. I forgot the number, but it's an all-time record high, and it's twice the amount of the basis trade in 2019, which was funded by the same repo dollars. Right, so I'm extrapolating. If the 2-year basis trade short is twice as big as it was in 2019, then the problem, at least from that perspective, is at least twice as big. It's probably bigger than that. But I mean, I remember the story of who was that guy, Zoltan Pozar, and he became famous for like plotting out a map of the financial system and how the 2008 crisis, created a slew of dominoes and they all fell, and he was mapping everything out, and his map became famous. You'd have to be that good in order to figure out exactly how much bigger it is now than then. So I'm saying it's at least twice as big. It's probably big.
What do you think about Rafi Farber's insights on the potential for a repo market crisis? Rafi highlighted how vulnerabilities in the U.S. financial system, particularly within the repo market, could create ripple effects through the broader economy. According to him, mounting U.S. debt and tightening liquidity are setting the stage for a potential shock in the repo market, one that could drive more investors toward gold and silver as safe haven assets. Be sure to catch our next video for more insights from experts on precious metals and economic trends. It's the perfect follow-up to today's discussion. Thanks for watching, and we'll see you in the next one.